All right, so starting off with Jerry. Jerry says, I currently have a married put on XLE. Let's go ahead and go to the custom spread tool. We're going to take a look at a married put structure on XLE. And we purchased stock on September 16th at 80.76. Okay, so I don't need the date necessarily, but let's just go ahead and put in the prices here. 80.76 for 100 shares of stock, just to keep the math simple. And you bought the date was something, you have the September 16th 84 put at 81. That makes sense. All right. Great. So let's add in our 84 put, Jerry. 841. Let's just take a look at what this was, Jerry, before we did that. Okay. So this is a 5.8% manageable risk to start. We currently still have 147 days. It was probably opened a little bit further when Jerry opened it in this case. Now, you also said you have a June. Oh, Jerry, can you send that to me again? I'm sorry. The June 90 call, I believe. I think I missed the price on that one. So it looks like you sold a June 90 call against the position. $0.89. Great. Perfect. Okay. Now I'm going to look at your suggestion first, and then we're going to talk about some other topics that you might want to consider. Pretty good. So you lowered your risk down to 5.2%. Let me just clear this up here so it's easier to see. Stock's at 76.20. Below your cost basis. 84 put here is at 841. The June call still has 56 days to go in this structure. Now, Jerry wants to know, is it a good idea to hedge additionally to add a Bear Put Debit spread to this position? First, I'll need to take a look at the stock research, Jerry. I know XLE, I just want to see if there's anything important coming up. Last ex-dividend date was 3/21. Okay, not that that's really relevant. I just wanted to make sure what we were looking at here as far as dividends. You've probably received some of those too to help lower the potential risk on the position. Now, a Bear Put Debit spread, of course, some of you may be familiar with that, I'm sure. But what we're going to do, similar to what we saw with some of the butterfly discussions, is one portion of it. If I did an all put butterfly or a debit butterfly or debit condor, we're going to sell a slightly in the money put, or sell an at or just in the money put, and buy a higher strike put for a debit on the position. So we pay, let's say if we had a 5-point spread, let's say we pay 320 into the position or 350 or so as the debit. As long as the stock stays below both puts, we're going to be forced to buy shares of stock here, but we've bought the right to force someone to buy our shares of stock here. We get $5 back. In this case, we'd make a maximum 180 profit off of a 320 debit. It works as a hedge. A year ago, year and a half ago, and Jerry, let me jot this down here. Jerry B. Sorry. Okay, so about a year ago, we were asked a question during a presentation, was a debit spread a good hedge for a portfolio? Doing a debit spread on, say, SPY or one of the broad-based ETFs or indexes, was it a good approach to hedge the portfolio? And the answer is yes. And ironically, it worked better in that example than the other ideas that we had, except for one. I think shares of an inverse ETF or shares of a volatility ETF works better as a hedge. But the one concern I always have about doing a Bear Put Debit spread as a hedge is that if the decline you're fearing, is more than what you expected, this is a limited hedge. It's capped. Is it still a hedge? Yes. Do you still make some profit on this? Yes. If you set it up properly where, hey, I think this might fall to 70, so right now let me sell the 75 put and buy an 80 put, and it might be a 1-to-1 risk-reward ratio, so if it falls to 70, you're going to get $250 back. But that's another $6.20 down. My concern with a debit spread as a market hedge or as a position hedge additionally is that it's capped. If the downturn exceeds your expectations, you've capped the protection out. You did protect some of it, but it's capped. What is the advantage of doing this? Well, the advantage of doing it, rather than just buying a put straight out, for example, in this case, is that it's cheaper cost. Right? Instead of just buying the 80 put in this example as an extra hedge to profit to the downside, you're cutting the cost by almost in half by selling the lower strike put. I get that, but it comes with a trade-off. And the trade-off here, Jerry, is the fact that in this case, if the decline exceeds your expectations, you have a limited capped hedge in your position. But let's take a look at it. And now let's talk about some other things one might consider following the rules in the blueprints and the full course. So I don't know if I want to go all the way out to June, but I don't know if I want to go let's just go to June. That's where you have your call. We're going to put this hedge in place for, not June 3rd. I'm sorry, folks, for standard June expiration. And I'm going to stick with the at-the-money debit spread that's going to have closer to a 1-to-1 risk-reward ratio. We're going to sell the 75 put, and we're going to buy a slightly in-the-money 80 put. This is what's known as an at or out-of-the-money debit spread. Instead of doing an in-the-money debit spread that has a high probability, but might only have a 6-to-1 or 7-to-1 or a 1-to-7 reward to risk ratio, really 7-to-1 risk reward ratio, doing this at or slightly out-of-the-money debit spread is going to give us closer to a 1-to-1 risk-reward ratio. We're going to get about 355 here, and we're going to pay about 640 here. Okay, so let's take a look at what we're doing. We're going to sell the 75. Remember, our true risk is 4.8% now with the call in place with a max return of 5.2%. And we're just going to do one contract of each, of course. I'm going to keep it in June. Now, you lower the risk, kind of, to 4.2%. You take away from the return, of course, because of that additional cost. So roughly, we're paying about, wow, this is actually pretty good. Sorry about that. This debit's about 273, 274. We're collecting 355. We're paying 627 at it's if you get midpoint. Okay, in this case, Jerry. So it's a good hedge. You lower the maximum risk to about 4.2%, but it's tricky. We got to read the graph. The profit and loss chart here is showing us the maximum risk, and the maximum risk is at 80. If the stock goes to that strike price of the put that we bought at June expiration, those two puts expire worthless. You've lost that extra debit of 270, which added to the total cost basis of your position. So that is the point where the risk is higher. We're talking about 381. But here, to the downside, if it falls to 70, 65, 66, we're looking at a loss of only about 200. Just about half. So it'd be about 2.1%. There's a lot of loss in this area. But of course, there's also a lot of opportunity. There's nothing to say you would, or you'd even have to hold this all the way to June expiration. If we see a fall to May, you might have a profit of 40 or 50% of the max profit you expected on that Bear Put Debit spread. You could close it out if you think you've bottomed and then readjust the married put position going forward. Okay, so that's a consideration, but it lowers the risk if it really falls. We're talking to 65, 60, 16-point drop on a $76 stock if you're concerned about it. Okay, for an additional cost of, what did I say, 270, 272, something like that. Yeah. Okay. So, but it did lower the risk. But now the max return in June is capped because of the extra cost too. Again, you'd probably be managing that far out in time, at the money, out of the money, Bear Put Debit spread. Doesn't put it to a profit if the stock really falls. But again, we see what the numbers are here. Now, another consideration that I might have in this case is still, okay, I'll keep June to be fair. And we saw an additional debit of 270. But again, if I paid a little bit more and just bought an extra June 75 put instead of selling it as part of that, if I bought an extra put, what does my position look like now? Now, if the stock fell to 65 or 60, where you had that 2% loss, you'd be at a profit. Max loss here, though, does go up to 6.9%, and that's at this peak at 75. We're up to 633. Is that worth the risk? Probably not in this case. So this is something that can be used. This is an income method that is used, but it also caps the upside here. So I don't think this structure is what I'd want to do. But it's a possibility. It adds cost of 355 instead of 270. And if you're expecting that big decline, you could be seeing a profit on the position even well before, of course, June expiration. What is your fear of the decline, of course, and what is your fear of how deep the decline would be? Does the Bear Put Debit work as a hedge? Yes. Is there a different structure I could use here for this income method, adding the extra put? Of course, this isn't the structure I would use. It's not the structure talked about in the blueprint, but it's something that could be considered. The other consideration we could have here is a part of a quote-unquote further hedge on the position. It's not as much as I'd hoped, but you sold this for 89. You could buy it back now for 50. You're almost making 50% on this call. And you could consider adjusting your September put either down in strike or down in strike and closer in time to help lower, that initial maximum risk we had of 4.8%. There's potential that we could lower that further as a hedge and sell a lower strike call. What I mean, buy this back at 50, so we keep the 39 cents, maybe adjust this put down and maybe closer in time, which could lower the potential at risk here that we already have. And then maybe look to sell an 80 call for June and collect a higher premium. So in addition to adding a Bear Put Debit as an extra hedge, you can manage what you already have open to accomplish the same feature, lower the risk potentially, not necessarily increase the return. You won't increase the return, but you could get more premium in, manipulate the put in different ways. IM number 3 and a combination of IM number 3 or IM number 9 from the blueprint, Jerry. That could get you into potentially lower risk structure if you're more concerned about a near-term decline on the position. Get some more income with a lower strike call, and then maybe still analyze that Bear Put Debit spread as a hedge. In the previous discussion we had for CoCon, the first thing I mentioned is that rather than switching points or overcomplicating, switching strategies immediately from bullish to bearish, the most important thing I think to do is in situations of uncertain markets, when we start to see these drop downs and start to see these declines, Jerry, is to manage the positions first. There are ways to manage this with what you already have open that could potentially put you in a better risk situation and keep a relatively same return with a similar structure that you already have. Call out to June, put maybe bring closer in, maybe bring that into June. Maybe we could get a lower price in that scenario, lower the risk down in those scenarios potentially. And that could be something to analyze, managing what exists first before complicating it with other scenarios. The debit spread would give a hedge, and we saw that. Kind of gave us a funky looking profit and loss chart, but you could manage that debit spread prior to what we're looking to do, prior to the June expiration that we set up as well. So Jerry, those are my thoughts there, and I will make sure to email you that previous discussion that we had that discussed the Bear Put Debit as a hedge in the portfolio, but it would relate to same as this as well. Is it appropriate? Your real question was, I want to hedge additionally, would a Bear Put spread be appropriate? It is a way to do so, and you saw the advantage of that as well. And also, to be more clear about what I have mentioned, oh, you said you have to leave at 5, Jerry. I'm sorry. This is recorded. Don't sweat it. You'll get that up there. But Jerry, yes, when you would roll down the puts and how many months out, I don't think I'd extend this past September. I usually roll down when I get to a full strike. In other words, you bought the stock at 80. You bought the 84 put. The stock's now at 76. When it got down to about maybe 75.50 or 75, it's moved full 5 points down from where you bought it. That's when I might consider rolling. Usually it's about 5 to 7% decline from your purchase price, which you're about at now, is when we might look to apply that income method number 9. And we'd either keep the same expiration in this case, because it's still pretty far out, still 147, near that 150 day out in time. But if I wanted to lower the risk because I'm more concerned of a bearish position, I might lower it down and move it closer in. That'd be a combo of income method number 9, Jerry, and income method number 3. And we can talk about that sometime later if you had to go. But again, I'll send you that other video about the hedge using the Bear Put Debit spread as a total market hedge on the position. versus other ideas. And that'll give you some insight into this as well. All right, Jerry, so thank you for the excellent question. Thank you for sharing your position with us as well. Hopefully that gave you some good analysis, and we can discuss that further later on.